Hi everyone, I welcome you all in my this lecture, and this lecture is related to bond evaluation or pricing of bond, or we can name it bond is also a long-term security, or that's also financial assets, one of financial assets. So here we'll be talking about how we can evaluate the bond and how we can price the bond. Um, I will take a quick look on the accounting equation. As we know, assets are equal to liability plus owner's equity. There are two types of assets. One is current asset, second one is fixed asset. And fixed assets which are physically available, they are also called the uh, real assets. To meet the requirement of real assets, we have the right side of equation. Here are the liabilities plus owner equity. In our last two lectures, we have explained the owner's equity and the owner's equity and how we can evaluate or how we can uh, price the stock. We have explained in detail with different models. Today lecture deals with the liabilities, and liabilities there are two types. One is short term, second is long term, and we are talking about bond is a long term debt, and there are two types of long term debt. One is tradable and second one is non tradable. If I discuss the non tradable, it means it means only have the book value. It means they are the bank loans, they are syndicate loans. Also we name it syndicate. Name is also named by called by consortium. That is a consortium of different banks to meet the requirement of a company for fund fund providing. That is called syndicate loan. This is non-tradable side. Here the bond is tradable, which is traded in the market, having the book value as well as traded in the market. These are the bonds, these are the debentures, these are the term finance certificates. So we will focusing on bond because we are going to explain the pricing of bond and valuation of bond, or that is one of the financial assets. Bond is a paper having the face value written on the bond, and it's the debt instrument issued by the firm or corporate or government. So bond is a paper which is having face value. What is face value? That is price of bond written on the bond held till maturity. So bond is a paper having face value written on the bond, and it's the debt instrument. And why it's debt instrument? Because it's long-term debt, and we can name it that is a debt instrument issued by the firm or government. What is debenture? Debenture is also the debt instrument issued by the firm having fixed rate of return. Having fixed rate of return. Term finance term finance certificates is also the debt instrument raising debt issued by the firm for raising the short-term or medium-term funds. Syndicate loan, this is non-tradable. What does it mean? Syndicate loan or consortium, it's the joint venture of different banks providing a loan to a company or firm. It means firm is required some financing, and firm is going towards the loan non-tradable side, and the bank is, if one of the bank, if one bank is not having the capacity, then they will go for the joint venture. They will different banks will give the provide the facility to meet the requirement of financing of particular firm. So that is called consortium or syndicate. More than one banks join for providing a loan to a firm. When one bank is unable to provide loan to the company, they join with each other and meet the requirement of the particular company. That is called syndicate loan or consortium between the banks. When we talk about bond, there is a coupon. What is coupon? That is interest earned on the bond. You can say it's a coupon rate. While we talk about stock, and stock that is there is a profit of stockholder or shareholder, that is named dividend. While we are talking about project deals with the net present value creation, either it's positive or negative. If the value creation, what does it mean? More than zero, it means their value is value creation. Value creation is the value greater than zero. It means the project is having some positive value. Then if the NPV is positive, then we select that project. Otherwise, we reject that project. So there are different, as we know, different methods, approaches behind the selection of project, like discounting techniques and non-discounting techniques. And net present value, it means here we are talking about time value. Okay, time value is discounting approach, and the other are non-discounting, like payback period, accounting, rate of return, and so on. And here the net present value and IRR are the most preferred, but the widely preferred is NPV, and IRR is can give the inconclusive results when there are mutually exclusive projects and the cash flows are there is trend in the cash flows. It means sometimes cash flows are positive, sometimes negative, and so on. Then IRR will give you the inconclusive results. Then we prefer the net present value approach. When we talk about company, there are future cash flows. These are the components. Coupon is related to bond, dividend is related to stock, NPV is related to projects, and future cash flows are related to company. So our lecture is price or value of bond. How we can price? As we know, price is a present value of future cash flows which are discounted at appropriate rate of return or discount rate. There is also a cost of loan, cost of debt, as well as cost of equity. So if there is cost of loan is always the cost of loan is interest we pay and denoted by I, and this is non-tradable. And tradable, there are bonds and stocks. Okay, tradable, they are bonds and stock, but in this lecture we are focusing on bond. So the tradable cost we pay denoted by KD. If it's KD, that is cost of debt. Bond is instrument of debt tracing. And here if it's KE, that is cost of equity. When firm issues the equity, then there is cost associated, and that cost is denoted by KE. So KD is cost of debt, KE is cost of equity. Important steps while we are discussing the bond. There are four parts while we are discussing the bond. First one is pricing or valuation of bond. At what price I will buy the bond? Okay, what is the most appropriate price? Well, while I will buy the bond, at what price the company will sell the bond? The second point is, which we will be focusing, that is the yield to maturity. Yield to maturity is average rate of return if the bond is purchased on market price and held till maturity. So yield to maturity is a rate of return, average rate of return of a bond if the bond is purchased on market price and held till maturity. So yield to maturity, it's not fixed and it's variable over the life of bond, but the coupon mostly remains fixed. Third relevant component is duration, that is the average life of bond. Higher the life of bond, more will be the risk. The fourth point is convexity. Means that is sensitivity of bond price due to change in interest rate or rate of return. Due to change in interest rate or rate of return or yield to maturity. So these are the 4 points which we will be discussing in today's lecture. Indenture, that is terms of contract while firm issues the bond. These are the terms of contract. Coupon rate, that will be also part of terms of contract. Interest calculated on the face value. So coupon is always calculated on the face value of bond. Then there will be face value in the contract. What is face value? Face value is price written on the bond. Held, which will remain fixed, which will be given to bondholder at the time of maturity. That's the price written on the bond which the bondholder will receive at the time of maturity. So maturity, what is maturity? That is life of bond. Here is the payment schedule. Payment schedule of what? That is the payment schedule of coupon amount. That is the payment schedule of coupon amount. Frequency of payments which can be made. It can be the frequency of coupon payments can be quarterly, can be annually, can be semi-annually, can be monthly. Means it will be mentioned in the terms of contract what will be the coupon payment schedule. Callable or not, either the bond is callable or not, it will be mentioned in the contract that either the bond is buyback by the firm or bought by the firms. If it's buyback, that is called callable or not by the company before its maturity. Either the bond is buyback by the firm before maturity. If it's buyback, that is called before maturity. So there will be redemption value if callable. If it's callable, there is redemption. If it's callable, there is redemption. What is redemption? Price of bond before maturity if it's callable. If it's not callable, obviously at the time of maturity, the bondholder will receive the face value. So redemption is related to callable bonds. Callable, it means buyback by the firms before its maturity. Then what will be the price? What will be the price of bond before maturity if it's callable? Callable or not? If callable, then redemption. What is redemption? That is price before maturity. Next is convertible or not. So either the bond is convertible or not into stock at the time of maturity. So the always we know if it will be also the part of terms of contract. Either at the time of maturity, bond is converted to stock or not. So it's part of term of contracts. So there is an example. If bond price is 1000 and market price per share is 100, so 10 shares are equal to the bond price. So if it's convertible, then the company will give the issue the offer the 10 shares to the bondholder. It means the bond is converted into stock. Next is collateral or security. Either the bond is secured or unsecured. If it's secured, then we can say it's mortgage bond. If it's mortgage bond, it means there is something pledged, there is collateral. So bond is secured. If it's secured, that is called mortgage bond. If it's unsecured, that is called NAC bond. These are the terms of contract, and terms of contract is called indenture. So here are the types of bond, and as we have explained in detail before, the types of bond, there are 2 types of bonds. One is government bond, second one is corporate bond, and there are further 2 types of corporate bond. One is domestic bond, second one is global bond. We will explain in next slides. What is government bond? Issued by the state at zero coupon rate, issued by the state at zero coupon rate. So what will be the interaction? What will be the attraction of investor? So issued by the state at zero coupon rate. It means, what does it mean? The face value will be more as compared to market uh, at the price which bond is traded in the market. It means face value is more, and I suppose the face value of bond is $100, and it's in the market its price is 90. So the difference between 100 and 90 is $10. That is the profit. Okay, that is the attraction of investor. If the life of bond is less than a year, we can name it T bills. If the life of bond is over a year, that is called T notes. But these bonds are issued by the government. They are secured bond. They are secured bond. T bills are always T bills are always issued in discount basis. Issued in discount basis. Always face value of bond is less than always face value of bond is less than its today price. Okay, face value is same as future value. So these are the terms and conditions related to bond. So corporate bond issued by the company and maturity will be more than a year. There are two types of bonds and corporate bond. There will be coupon and face value. So two types of bonds, corporate bond. One is domestic bond. Second one is global bond. Domestic bond offered to only local investors. That is domestic bond. Global bonds offer to both local and international or foreign investors. Okay, that is called global bond. So here are different features of corporate bond. First feature deals with the type of corporate bond, either it's foreign or euro bond. Second feature deals with the its characteristic. Third is related to coupon, and fourth is related to either it's secured or unsecured. Okay, collateral, and fourth is related to Islamic Sharia compliance bonds, sukuk bonds. So these are the 5 features of corporate bond. We will discuss one by one here. The foreign bond. First step, foreign bond and euro bond. In first step, there is foreign bond and euro bond. In second step, there are 3 components: dual currency bond, currency option bond, cocktail bond. Then third characteristic, that is related to coupon, zero coupon or coupon payment bond. Fourth is secured or unsecured. Secured is mortgage and unsecured is net. The fifth is Islamic bond, means sukuk bonds. We will discuss in next slide. So the first point is foreign bond. It means if the US company, means in a foreign company, issues the bond in local currency. I suppose there is an example. If the US company issues the bond in Pakistan in rupees, what is the local currency? Rupees. The company is from US company is issuing the bond in Pakistan in local currency. What is the local currency of Pakistan? That is rupees. So currency is same as per the country. The bond which is issued in which currency? As per the local as per the country currency. Euro bond. Euro bond. If the US companies issued the bond in Pakistan into its own currency, means USA currency is dollar, and USA company issues the bond in Pakistan in dollar, that is called euro bond. Different currency as per the country currency. So the bond currency is different. So the bond currency is different as per the country currency, that is called euro bond. Then second part deals with the characteristics of bond. Dual currency bond. Dual currency bond. Look at here. Dual currency means bond is there are two parts related to bond. Two things related to bond. One is face value. Second one is coupon amount or coupon rate. Coupon amount. So dual currency means coupon in one currency, what's left? That is face value. Face value in another currency. So that is called dual currency bond. Currency option. Here is option. On what? One is coupon, second one is face value. There is option. So if it's currency option, coupon is choice of investors. Coupon is choice of investors. Investor can take the coupon amount either in any currency, whatever he or she wants. So face value is desire of the company, but here the investor is not having the choice. Here is the choice of company. Here is the choice of company. The face value will be given to bondholder in any currency, whatever the firm wants. Okay, that is desire of company. The third is C part is cocktail bond. Here the choice on face value. Investor has the choice on face value, but in the currency option, the investor was having the choice on coupon. Here the investors are having choice on face value, or bondholder are having the choice on face value. But coupon amount, that will be issued by the firm, whatever firm wants in any currency. Okay, coupon is the desire of company. So these are the characteristics. Dual currency bond means coupon in one currency, face value in other currency. That's name. Look at the word, that is dual currency, and there are two components. One is coupon, second one is face value. Okay, coupon in one currency, face value in another currency. The same I have explained. The currency option, when the coupon is choice of the bondholder, but the face value is the choice of company. Cocktail bond, here that is the opposite of currency option bond. Here choice is on face value. Here the choice bondholder has the choice on face value, but the coupon is the choice of company. Zero coupon bond, the third part is no interest on the bond. Coupon payment bond, that can be the fixed rate, and there might be floating rate. What is SkyBor plus fixed rate. Once we talk about the floating rate, is SkyBor plus fixed rate, Karachi Interbank offering rate. So the rate is issued by the State Bank of Pakistan to commercial banks for lending or borrowing within the banks. So that is called SkyBor plus fixed rate. So there can be fixed rate or floating rate. Fourth and fifth parts. Fourth is related to either it's secured or unsecured. If it's secured, that is called mortgage bond. If it's unsecured, which is called naked bond. And the fifth part deals with sukuk bond, Islamic bonds. They are Sharia compliance bonds. Here we have an example. What is an example? 10% of $1,000, 10% of $1,000 face value bond is traded in the market, having 5 years life, and rate of return is 12%. Means discount rate is 12%. Yield, that is yield rate or discount rate or interest rate. What we have to find in this question: what is the fair price or value of bond? What will be the duration? What is the convexity? If the yield rate is increased or rate of return is increased by 1% and decreased by 2%. Here always remember, the rate which is given before the face value always represents to coupon rate. The rate which is given before the face value always represents the coupon rate. We can solve this question. The face value is 1,000 and the life is 5 years. So the 10% is the coupon rate. So the coupon payment will be and it's annually compounded. Okay, it's discounted on annually basis. So the frequency is annually. So at the end of, so coupon rate is 10%, face value is 1,000. We can find the coupon amount, that is $100. The maturity is 5 years, and value of KD means cost of debt. Cost of debt is 12%. At zero, that is today. That is today. The payment will be, coupon payment is made over the end of each year. So here is today, no coupon payment. After 1 year, that is after 1 year, the coupon payment is 100. After 2 years, the coupon payment is 100. After 3 years, the coupon payment is 100. After 4 years, the coupon payment is 100. At 5th year, the coupon payment is 100. How it's 1100? Look, face value. When the investor or the bondholder will receive the face value at the end of at the end of at the time of maturity, at the time of maturity or end of life. So the time of maturity, it's the 5th year. What was the face value? 1000. When the bondholder will receive at the time of maturity. It means what is time of maturity? End of 5th year. So end of 5th year is here. So end of 5th year there are two payments. One is coupon payment 100. Second one is face value. So that is 1000, which are equal to 1100. That's why here is 1100. So every year at the end of each year, bondholder will receive 100 coupon amount, but at the end of 5th year, the bondholder will receive the face value as well. Face value as well. So in this case, in this example, at the 5th year, 100 is coupon amount and 1000 is face value, and their combination is 1100. So at the end of 5th year, the bondholder will receive $1100. So we can find the price, that is the same formula. C1 means coupon amount of first, here the coupon amount of first year divided by 1 plus I, if we keep in mind the present value formula. So there is the 1 plus I, but we are talking about debt. So that is cost of debt raised per 1 for second time period. That is the coupon amount of second year divided by 1 plus KT raised power 2, and for coupon payment 3, so C3 divided by 1 plus KT raised power 3 for fourth year. Coupon payment fourth year divided by 1 plus KT raised power 4 for fifth year, 1 plus KT raised power 5, and plus face value divided by 1 plus KT raised power 5. Here is the power 5, here is the power 5. So once this is the 100 and here is 1000, once we put the values, or we can solve that there, we can put the 1100 divided by 1 plus KT raised power 5, or we can solve it, this cash flow we can solve separately, and this can be solved separately. Look at here, we place the values. 100 is the coupon payment, and this is the coupon rate is fixed. Coupon rate is fixed over the life of bond, so the coupon payment will be also fixed. And what is coupon payment? That is 100 divided by what is the discount rate, that is 12%, 1.2 raised power 1 plus 100 divided by 1.2 raised power 2, and so on. And here is the 100 divided by 1 plus 2 raised power 5, and here is 1000 divided by 1.2 raised power 5. We can solve, up to you. Here you can solve, put 1100 divided by 1.2 raised power 5, or you can separately solve it. So once we simplify it, the price of bond is, the fair price of bond is $927.4. So the face value is 1000, but the face value is 1000, but the fair price is present value. That is $927.4. We can solve this question in tabular by the help of tables, and we can solve this question in tabular form. So the cash flow of 1 year 100, second year 100, third year 100, fourth year 100, fifth year 1100. I have explained, and here we can extract these values, and these values are present value interest factor, at which rate I and T. I and T. What is interest rate? That is 12%, means cost of debt is 12%. We will check in first year the value of present value interest factor in first year at 12% is 0.89, 0.79, 0.71, 0.63, and at fifth year 0.566. Then how we can find the present value? Means price of bond. Price is a present value. Price is a present value of bond. So cash flows multiplied by present value. Interest factor 100 multiplied by this 89.1. Then 100 multiplied by 0.79, 79.7. 100 multiplied by 0.717, 71.1. 100 multiplied by 0.634, 63, and 1100 multiplied by 0.566, 623.7. The sum is 927.4. You can solve either by this approach or you can solve by this approach. What was the first part of the question? What is the fair price? The fair price is $927.4. And what is the face value? That is $100. So the second point is what will be the duration? What is duration of bond? What is duration? Duration is an average life of bond. Average life of bond. So the formula of duration is sum of cash flows multiplied by present value interest factor multiplied by T. Whole divided by sum of cash flows multiplied by present value interest factor. What is this? That is the price, present value. That is present value. So what is the present value? Means price of bond, that is 927.4. But here nothing is going to multiply or adding. So here is the present value or price of bond is multiplied by T. So we have to generate a new series. We have to generate a new series. Here what is this? Cash flows multiplied by present value interest factor. Here we will put the bracket here. Here we will put the bracket. And what is this? Cash flows multiplied by present value. So 89.1 multiplied by T. Here in first year the value of T is 1. 1 multiplied by 89.1 is 89.1. 2 multiplied by 79.7 is 159.4. 3 multiplied by, here time is third year, so 3 multiplied by 7.1 is 213.3. 4 multiplied by 63.4 is 254, and 5 multiplied by 623.7 is 31,018.5. Here is the sum, 3,834.4. So in the formula we are required sum of present value multiplied by T, that is 3834.4 divided by the price of bond. Okay, 927.4 is 4.13 years. 4.13 years. Always the duration is less than, because its average life its average life is 4.13 years. So the average life is less than a maturity, and the life of bond, its maturity is 5 years. So as I have explained, that here is the present value interest factor. What is this? This is the present value interest factor 1 divided by present value interest factor. The present value interest factor is 1 divided by 1 plus I raised power T. You have already have the grip on time value of money. You have already have the understanding of time value of money. So the present value interest factor is 1 plus I raised power T. So the present value of future value interest factor is 1 plus I raised power T. 1 plus I raised power T. You already know these expressions. The third part is convexity. What is convexity? That is the sensitivity of price due to increase or decrease in interest rate. Convexity is, what is convexity? That is the sensitivity of price due to increase or decrease in interest rate. So here the formula is minus T. What is formula? Minus T. What is T? That is duration multiplied by I divided by 1 plus KT. I divided by 1. Here not I, that is change in I, delta I. Here is delta I. I think I have made some mistake. It's delta I, change in I. So look at the previous example. If the interest rate is increases by 1%, so the value of convexity is minus, that is the minus of formula, the value of d is 4.12 multiplied by 1%. It was increased by 1%, so the value of interest here is positive, plus, where here the value is positive, so 0.01 1%. Once we convert it into decimal, it will be equal to 0.01 divided by 1.121 plus what's value of KD, that is 12%. After simplifying, we can first we solve this part, 0.01 divided by 1.12. As we know in mathematics, first of all we solve the bar, then we solve the small bracket, after that we solve the curly bracket expression, then the braces expression, then we go for the division, later multiplication, after that addition or subtraction. So in this case, first we solve this part, then we multiply. So here is minus 0. Here is minus, not plus, because here is minus. The answer is minus 0.037. What does it mean? Minus 3.7%. Minus 3.7%. It means if the interest rate is increased by 1%, the prices decreased by 3.7%. Okay, that is the sensitivity of price. Convexity is sensitivity of bond price. So if the interest rate is increased by 1%, then the price is decreased. Here I have made a mistake. Here it's minus. Here it's minus. Here it's minus. Okay, you have to be careful. Here I can change here now. Okay, it's the minus. Okay, here is minus. Okay, and here we can put the bracket, and again bracket, and it's the change. I can write the change in I, that is 1% divided by KD. Okay, so you should be very careful. So I think you got this point. It means then if the interest rate is increased by 1%, then the price will be decreased by 3.7%. That is the how much the price is sensitive towards the change in interest rate. Okay, there was another part, that is yield to maturity. So the KD is rate of return. So the yield to maturity is KD, cost of debt. Average rate when the bond is purchased at market price and held till maturity. Okay, what is yield to maturity? That is average rate of return at which bond is purchased, and the bondholder will keep it held till maturity. Okay, and that is the average rate of bond. That is the average rate of bond, and which will remain held till maturity. Okay, higher the rate, lower will be the price or present value. It's understood. Higher the interest rate, because its price is the present value. Higher the rate of return, lower will be the present value. More the time period, lower will be the present value. So the formula of yield to maturity and pricing, we can calculate the yield to maturity from the pricing formula. If one thing is missing, we can find the other thing. Okay, so here is the formula of pricing, where we are putting the annuity formula. Annuity, as we know, present value of annuity is coupon amount, means once we are having more than one same payments. Keep in mind the example of last last example, keep in mind the last example, there were the coupon payment was fixed. Every year we were getting $100 at the end of each year for 5 years. So we are having the more than one equal payments. If you are having more than one equal payments, that is called annuity. In previous example, we were having 5 years equal payments. So we can use the present value of annuity formula, and the present value of annuity formula is coupon means equal payment amount multiplied by whole multiplied by 1 minus divided by 1 plus divided by 1 minus 1 divided by 1 plus yield to maturity, means here is KD, or we can name it yield to maturity raised power T whole divided by yield to maturity plus face value divided by 1 plus yield to maturity raised power T. Same as we have done before, we can go for either the annuity formula or either we can go for the individual cash flows. What is first individual cash flow? C1 divided by 1 plus yield to maturity raised power 1, C5 up to C5 1 plus what is this coupon amount at fifth year. I suppose we are taking example of a previous question. If the maturity is 5 year, here the yield to maturity 1 plus yield to maturity raised power 5 plus what is this? This is face value. Always the bondholder will get the face value at the time of maturity 1 plus YT yield to maturity raised power 5. How we can find the yield to maturity? Yield to maturity can be found by hit and trial methods or trial and error methods. Okay, price or present value of future cash flows of a bond will be equal to its face value when it's the face value and price will be equal when the bond is discounted at coupon rate, means rate of return is equal to coupon rate. Once coupon rate and rate of return are same, then we can say the market price will be equal to present value. Okay, the face value will be equal to market price because they are discounted at par. What is par? Means coupon rate and rate of return are same, then we can say that the bond is traded in the market at par. Then the face value and present value, will be same. And present value, what is present value? That is the price of bond which we have calculated through formula. This is the hit and trial and error method, how we can apply this method. Here we assume a rate, discount rate, and calculate the present value. The rate which equates the face value and price, means present value, that is the yield to maturity. I repeat again, the rate which equates face value and the present value, that is called yield to maturity. I suppose first you assume a rate. If the present value is less than the face value. If the present value is less than the face value, then you decrease the rate. Then we decrease the rate and calculate again. This is the hint. If the present value is greater than the face value, then we increase the rate and calculate the present value. Hit and tail. What does it mean? You have to try more than one times. Okay? Then what is the yield to maturity? It means the rate which equates face value and present value or price of bond. Okay, that is the yield to maturity. When coupon rate and rate of return are equal to each other, that is called then the face value will be equal to, when bond is discounted at coupon rate, then during its life at any time, then we can name it the present value is equal to is face value is equal to present value. Here are some key findings selling the bond. How we can sell the bond: discounting, par, and premium. These are the terms which are used in the market. Par, it means the bond is traded in the market at par value. What does it mean? Yield to maturity is equal to coupon rate. It means market price is equal to present value. Discounting, it means market price is less than present value. So yield to maturity is greater than coupon rate. If it's traded in the market at premium, it means market price is greater than the present value. What does it mean? The yield to maturity will be less than coupon rate. So these are the terms we normally use in the market. So this is all about today lecture, and our next lecture we will discuss the some topic related to financial management and so on. I'll see you in next lecture. Thank you very much. Take care. Stay blessed.